that's what's going to happen. It's just to be dragged down because kick the can, kick the can, kick the can. You can devalue the dollar 97% over and over and over. There is no limit to how much you can do. And the 1973, only because the dollar index started in 73, 1973, $1 right now just went below 2 cents on the dollar. So there's your purchasing power decline the dollar. I believe so. I think if you look too, and even to really simplify, and of course it's not at all simple, but if you just look at a chart of the 30-year T-bond, it's been down, for 40 years. It broke out. It's kind of lower inflation, lower yields. It's trust, and it's the polarization geopolitically and what's going on with China. All right, so two things, the major drivers here. And I think in trust is funny because in 2020 I did a speech at a conference and kind of looked at the dollar, and it says on the back, in God we trust. Well, I think you have to answer that question, you got to take a step back on something that you just mentioned, which is key, which is, getting to this debt and the dynamic around when does it start to matter? Because that's kind of the key. It hasn't mattered. We've always had it. It's always been an issue. So when does it start to matter? So I kind of look at it in two ways, and I actually have a quote. I think I have it over here. I'm just going to read this quote to you, and you might,
please.
You're probably too young to remember the Vietnam War, right? But I remember, I was a kid during the Vietnam War. And there's a great comment from Pete Seeger, who was an activist and anti-war guy, and he said, look, talking about the attitudes towards war among people here in America. So the world is a seesaw that's out of balance. On one side, a big bag of rocks tilting its way, holding it down. On the other is a box that's empty, and there's a bunch of us standing around with teaspoons, adding a little sand at a time. And at one point, all that sand's going to add up to drive the bag of rocks the other way. And there's physics around this because I'm a science guy. Of course, I know all this, the rotation angles, the equilibrium points, all the dynamics around what actually causes it to flip. It's tipping points. And if you plot U.S. public debt, and God forbid you add household debt, which including nonprofits is over 20 trillion, public U.S. debt to close to 38 trillion. She's talking about almost 60 trillion in debt that we, the people, households and public, because of course it's our money, we're borrowing against us, and then the Treasury selling us back our own debt at a price in a currency is going to be devalued over time. So the whole thing kind of seems crazy to me. But when you think about it that way, when you plot GDP against, how public debt, it's pretty standard, movement between the two, pretty static ratio between the two until 2008. And QE changed everything. You monetize government debt, you become Venezuela, Argentina, Turkey, and all these countries. And what happens? Well, you saw the debt pull up to GDP, and now it's rising until COVID, and everything blew out. All right. I liken it to a black hole. And I call it the debt black hole. And I've been calling it, we've had this discussion, for the last about 18 months or so since I kind of just put this chart together where I was like, wow, that's really amazing because it gives you a tangible, visible mechanism to see what this is. And in a black hole, you have the event horizon. Once you cross the event horizon, the tipping point, you can't escape the black hole. You don't know you're in there yet because it's not, it's mesmerizing your atoms yet. It will, obliterating them. But you also can't escape it. And as much propulsion as you may try and exert, you can't get out. And in this case, the debt black hole, we're so far in now, it's such a big gap now. I mean, you need about, if you include household debt, about $1, household debt, you need about $1.85 in new debt to create $1 of GDP growth. You need the growth to service the debt, which is now out of control and servicing costs. So you have to keep doing the same thing, even though you'll never get out. And the dynamic of the propulsion here is, of course, what? Burning more dollars that you continually print. Now, the question becomes, all right, is it a problem? All right. I wrote in the book I wrote in 2006, I called it Monetary Armageddon, where you have the Treasury guy and the Fed guy in the monetary bunker with the keys. They're going to turn simultaneously and print enough money to buy 58 trillion in debt back. And then I did the math on this and money supply and everything. It's like a $20 piece will cost $786, So that's what's going to happen. It's just to be dragged out because kick the can, kick the can, kick the can. You can devalue the dollar 97% over and over and over. There is no limit to how much you can do. And the 1973, only because the dollar index started in 73, 1973, $1 right now just went below 2 cents on the dollar. So there's your purchasing power decline the dollar. So how does that relate to the Treasury market? Well, they could certainly save it by buying every debt. It's going to be a continued thing. And that's the question of, I think the next step for us is yield curve control, because, they're going to have to keep rates low to keep the consumer floating, because the consumer's hurting, for the most part. And now even the top income level is starting to feel the pain, according to Fed surveys. If the stock market gets whacked, they're going to be hurting. And if AI starts destroying jobs, it's a dagger in the back of the U.S. consumer. Without growth, you're in trouble with the debt.
America's financial system rests on an unprecedented mountain of debt. Public debt is approaching $38 trillion, add household liabilities, and the total climbs near $60 trillion. For decades, debt and economic growth moved in tandem. But after the 2008 financial crisis and the era of quantitative easing, that relationship fractured. Today, it takes dramatically more borrowing to generate each dollar of GDP. Growth no longer drives debt. Debt drives growth. The system now relies on constant expansion of credit just to sustain itself. Without new borrowing, momentum stalls. With it, long-term stability becomes increasingly uncertain.
I believe so. I think if you look too, and even to really simplify, and of course it's not at all simple, but if you just look at a chart of a 30-year T-bond, it's been down, for 40 years. It broke out. It's kind of lower inflation, lower yields. You had, the whole dynamic around the internet, which was about price discovery. So this is all about deflation. What's coming next with AI will be deflationary for the consumer, for the labor market. And I think it's higher inflation and more deflation. It's more both. It's not, and I thought about this a long time. It's always a question. And it's kind of like, do you buy Bitcoin or gold? And it's like, well, to me, it's not it's not one or the other necessarily. Now, I'm not necessarily crypto, but, to me, this was kind of a silly argument to begin with, which is kind of the same when you kind of come down to this thought process around you could have both, where deflation in the consumer, in the economy is really inflationary for prices. And it's a rat wheel, man. You're just spinning the wheel. So I think it's more of both. And I think it's lower purchasing power. And it's like what you say, yield curve control works. It's like holding a beach ball, in the pool below the water. When you let go, it explodes. Well, that'd be inflation. And then when it explodes, that's when you're talking about, a depression and stuff. And the bottom line is, I think the one certainty I could say out of all this, and I hate to say it, I don't like being a doom and gloomer. I'm very positive in my life, on spirituality, on nature and all this stuff. But when you talk about the reality, which is what I get paid to do, measure risk and talk reality and talk truth, it's a lower standard of living at the end of the day. That's what all of this machinations will, be the end result for the average guy.
Imagine the economy as a black hole. At first, gravity pulls gently, but beyond the event horizon, escape becomes impossible. The United States may already be past that threshold. Research shows that nearly 180 of new debt is required to produce just $1 of economic growth. Servicing the debt demands even more expansion. This creates a feedback loop: print, borrow, refinance, repeat. Since 1971, and when the dollar left the gold standard under Richard Nixon, purchasing power has fallen dramatically. The system survives not by reversing course, but by extending time through monetary expansion.
It's an integral part, just like the macro fundamentals are, the supply-demand fundamentals are, the psychology of the market, the positions of the market. All the things, the swap rates. To me, and this has been my motto for, since I started doing this on my own 28 years ago, everything matters. Everything matters. And you have to put all the pieces, like a 10,000 piece puzzle, the picture, to tell you how to put it together, But yeah, it matters a lot, because this is a one-way street. It's an intensification that will continue. There'll be ebbs and flows, but this is something that is with us now to stay. You're talking about a 25,800 year cycle, a 230 million year cycle, and within that context, a cycle that can't necessarily be defined to exact years, but roughly 2,100 years, which roughly should be half of that. What I will tell you, Andy, and what I'm seeing is, I've been studying this for over 30 years. I studied under Anthony Avini, the Mayan culture, and it's linked to astrophysics and astrology and astronomy back at Colgate. And he was a leading authority on the Mayans. And the Mayan calendar maps all this out. That's what it was. It wasn't the end of the world. It's the recycling. You've heard of the precession of the equinoxes, for example. All these kinds of things play in. So to me, it's important in everything, because it's affecting everything. And I think the biggest takeaway is it means more volatility and crazier moves, and silver, being up, $20 one minute and down 30 the next. And that takes me all the way back, to when I first got into business, when it was kind of like, yeah, you open limit up, you trade limit down, you close limit up. And I think that these are the things we're going to see more of. And I think it behooves people to, I like to call them financial prophylactics, and certainly what you do would qualify as that in the biggest way. So, bullish on your business, that's for sure. No doubt about it.
The next phase may not be simple inflation. It may be both inflation and deflation at once. Artificial intelligence promises efficiency and job displacement, creating deflationary pressure in wages. At the same time, persistent money creation fuels asset inflation and rising living costs. If policymakers adopt yield curve control, capping interest rates while expanding the money supply, inflation pressures could intensify beneath the surface. Like a beach ball forced underwater, suppression builds force. When released, it rebounds violently. The outcome may not be immediate collapse, but a gradual erosion of purchasing power and a declining standard of living.
Yeah, it does a lot. I'd say there's two things. It's trust, and it's the polarization geopolitically and what's going on with China. All right, so two things, the major drivers here. And I think in trust is funny because in 2020 I did a speech at a conference, and kind of looked at the dollar, and it says on the back in gold, in God we trust. God's not going to pay back $58 trillion in debt, man. I mean, it's just not how it happens. So it's like kind of you're saying in the U.S. government we trust, and we know they can't be trusted. I mean, just as recently as 2 years ago, it sounds Biden's fine, all this shit. You go back to the Iraqi war, you go back to the Vietnam war, you go back to alien cover-ups, you go back to all the things. I mean, the government has proven. And to whatever extent, a lot of what you see here, I think, is designed to misdirect focus, because some of the things that I like to talk about, you don't see it or hear it or even really read it anywhere. It's as if it's veiled. I mean, it really is. And luckily, I know kind of where to look, and I like science journals and wherever I go. But I would say trust is a huge issue, and the dollar has always been the pinnacle of that trust. And if you go back, I know probably know Jim Brandt's work. I used to write for his website, actually. It's the pyramid. At the top of the pyramid is gold. And I think that's the trust thing. It's almost been flipped upside down now, and everyone's dumping into gold. So I think it's a huge part of this, massive part of this. And then, you talk about what's going on with the U.S. and China. It's also not necessarily China doesn't trust U.S. treasuries. They want to rule the world. It's if you understand Mao, first of all, Xi. I mean, his father was in the Mao administration. I'm sure they didn't call it that, but he was actually killed in an assassination attempt on Mao. And Xi was whisked away by the Chinese Communist Party, allegedly, and it literally was indoctrinated and taught, this whole Manifest Destiny Maoist vision of Manifest Destiny in Asia, sent to the U.S. to be Ivy League educated. He's very well presented, very well spoken. He's very intelligent, and he's been basically designed to do exactly what he's doing now and to take it a step further. Because if you start to look at really just simple, again, it's a war for resources and survival. And if you want to take the science part into it, I would add, that some of the science, especially around REEs and REOs, rare earth elements and oxides, you take something like dysprosium, especially a metal that changes dimensions and stuff. You talk about the survival of our species is at stake in many ways, and in not too distant future. So in that context, this is real hardcore stuff, and Xi is really playing the long game. We're here in the U.S., we're worried about getting reelected, or we're worried about having voters, or worried about, what are the surveys and the polls say about our popularity and all this, the social media, and who's arguing with who. Oh my God, you want to destroy the U.S., destroy from within. They're doing a pretty good job of it. We are, they are, everyone is. So I look at that as way ahead of the game, also in control a lot of the resources already, all right, and especially in the REE space. You talk about some of the things that we don't have. And again, you don't read this anywhere. You say, yeah, we have one of these REE mines in California, Nevada border, and it's great. It doesn't produce one of the 17 key REEs. We're so dependent. We don't have separation, concentration, even the making of products with some of these things. China is mostly has all that, let alone they have about 40% of the world's resources in REs, REOs underground in China. And then you have
and 90% of the world's refining of those rare earths as well.
Exactly. And people talk about this 60 or 70% thing. It's like, no, it's 90. And when you get down to certain products, it's 97 to 100%. And when you talk of that's Greenland, that's Arctic, but Greenland's small compared. We're small compared. Between Russia, Vietnam, and China, they own like almost all of what's known on the planet. And then you get to Taiwan. Why is Taiwan important? It's shipping. Why is Malaysia important? It's shipping. Why is Vietnam important? Because of oil rights offshore. Why is Philippines important? Because of fishing rights. Why is Korea important? Why? Because it's right across from the main shipping area into the Chinese ports. So it's a manifest destiny thing. And I think, too, when you talk about trust, this doesn't have anything with China's trust or Asia's trust. Maybe at some point, Japan starts liquidating. We even talk about the JGB market implosion, and how that might affect treasuries, will affect treasuries. But the bigger picture is that this is a much bigger game, from the top down than just, we're selling treasuries, taking the dollars and buying gold. It's way bigger. Xi's playing a long game. He plays above the rim. Biden played on his knees. At least Trump puts up some resistance, but Trump doesn't really jump too well, and Xi's way up here, man, above the rim.
Markets do not move in straight lines. They oscillate through cycles of expansion, contraction, and disruption. Today's environment reflects intensifying volatility. Long-term bond yields, after a 40-year decline, have shown signs of structural change. Commodity markets swing sharply. Silver and energy experience outsized moves in compressed timeframes. Economic cycles may also intersect with broader structural shifts, technological revolutions, demographic transitions, and geopolitical realignments. The result is amplified instability. Investors must prepare for sharper rallies, deeper drawdowns, and faster information flows. Volatility is no longer an anomaly. It is becoming the defining characteristic of the era.
I would say go outside, hop on a jet ski, go to the beach. No, I mean, seriously. But I think diversification is huge, and diversification, other than the diversification everyone thinks they know is diversification, which I buy different areas of the stock market, right? That's diversification. No, I mean, it's unfortunate that, you're at a point now where I love the futures industry, and I'm, a CTA, so we manage money. But what people don't really understand about the futures markets and why it's got a bad rap, as it were, is that they don't understand the math behind it. When you talk about gold right now, one old school contract, now they got micro contracts. Thank God, it makes it easier to manage the risk here, and will make it accessible to more people. And I think that's a really good thing. And in that context, I think young people should take advantage of these types of things. Okay, where right now the big gold contract's worth $500,000. So a normal percentage move relative to your risk of ruin, relative to what you're willing to risk, like per position, right, as a money manager, as opposed to I'm going to invest for the next 25 years. When you're investing for the next 25 years, I think you got to kind of compartmentalize it to where I have gold and silver physical, all right, number one, and small. And to me, it's all of this is really hard because you kind of want small denominations to some degree, because one of the reasons you would hold that would be some kind of scenario where you have a coronal mass ejection and we have no power grid. And then you need to barter, and you want to talk trust. There's your ultimate doomsday scenario trust thing of bartering with gold and silver to get food or energy or heat or whatever, rent, shelter, whatever it might be. So, having some of that, but that's hard to store. And if people know you have it, you're a target. So, there's so many different really angles on this. But I think the bottom line is have some of that, have some, to me, I think everyone should do it themselves. I think once Social Security finally gets eliminated, it'll be grandfather clause, right? Because really, do you want to trust the government to handle your retirement money? I mean, everyone resists this thing about doing away with Social Security. We should be embracing it, because if, you could probably do better yourself. Let's put it that way. And you'll know the money will be there. What it'll be worth and what it will buy is the big question. But I think that people need to be active in all these different things. And I mean, currencies, commodities, metals, the energy markets, stocks too, fine. I mean, stocks will go up for the most part because the dollar will be coming down. It's the tightest positive, opposite correlation. Dollar down, stocks up. Dollar up, stocks down. It's the tightest correlation of any two markets I've seen in my 40 years of doing this. So, and you see the Merval in Argentina. It makes a new high pretty much every month. The Turkish stock market, the BST 100 makes a new high every month because the currency is devalued. The problem is that the value of the stock isn't going up as fast as the value of the currency is going down. So again, it's a purchasing power thing. It's a standard of living thing. So don't just be invested in stocks and think you're going to, that's going to help you keep up with the purchasing power decline of the dollar. And if you're purely in dollars, that's a very bad move. So
Gold often acts as a barometer of trust. When confidence in institutions weakens, gold tends to strengthen. The US dollar has long stood at the center of the global monetary system, yet fiscal deficits and geopolitical shifts have prompted renewed interest in hard assets. Central banks worldwide have increased gold reserves in recent years, signaling diversification away from exclusive dollar reliance. At the same time, strategic competition between the United States and China over trade routes, technology, and rare earth minerals adds another layer of uncertainty. Gold's rise reflects not panic, but recalibration.
I think having some money in, say, the Aussie dollar right now is a good idea. I mean, the Mexican peso I even likes, the South African rand, the Brazilian real, and you could trade the mini contracts and futures, but you need to know the math, the risk, the underlying value of these contracts relative to your portfolio is so key in position sizing. And there's nothing wrong with having positions where I like what I spoke at a conference in 2023 when we first started really getting bullish on the mining shares, particularly the silver miners. I say, you take some of these silver miners that are $2, $3, $4. Trade it like it's a call option. Just buy it. There's no time decay. There's no expiration date, and be willing to risk the entire amount of money that you use to buy that particular stock and kind of treat it that way as if you're trading stocks, as if they're options on the price of silver, or in many other cases in commodities and different ways you can do this, particularly in energy. I think that's a great thing. And I mean, that's one of the ways, we had a phenomenal year, and, then my own, style, we don't trade stocks for customers. So I trade stocks for myself. And that was even better because, we're in the gold and silver mining shares.
So what's the best way for people not only to follow you on social media, but also if they're interested in working with you or learning from you, what's the best way people can get that information?
Sure. You can follow me on Twitter, which is at Weldon Live, WELDON Live. We do have a podcast. It's called Money Markets and New Age Investing. We do talk about the science sometimes, but it really is kind of more specific recommendations. Like last year, I kept telling people, buy the mining shares, buy the mining shares. And originally it was the low price Canadian denominated mining shares at the beginning of last year, end of 24, because the Canadian dollar was coming down so hard. They were the performers. And usually it's the big cap first, then the speculative miners follow. It was flipped this time. And I said, on the podcast and stuff and in the research, look, when you start to see Newmont, which have been a major laggard underperformer, when you start to see that move, higher and start to close the negative gap, relative to the rest of the sector, that was going to be a sign that Wall Street money was moving in, that JP Morgan, the guy JP Morgan and Merrill, has to justify to his boss if he loses money. Well, I own Newmont. You told me buy mining shares, right? And that's what happened. And all of a sudden they took off in the whole sector and said it would be the froth of the move in the metals. So the podcast that, is Money Markets and New Age Investing. It's on Buzzsprout. You can also follow me on YouTube, which is Gregory_Weldon. Or if you want to sample the research, I do reports all the time, special reports, my year ahead outlook, which is still pertinent. It's like 150 pages, but it's easy to read, single page charts. Be happy to send that to anyone. Email me, Greg Weldon, GREGWELDON @Weldon Online. And accredited investors, we are actually, for the first quarter here, open to new investors. Accredited investors only can get all the pertinent information and disclosures by shooting me an email.
For younger generations, the message is not fear, it is preparation. Diversification must go beyond traditional stock portfolios. Exposure to commodities, precious metals, multiple currencies, and productive assets may help hedge systemic risk. In inflation-prone economies such as Argentina or Turkey, stock markets often rise, but primarily because the currency falls. Nominal gains can mask real losses. The lesson is clear: measure wealth in purchasing power, not just price. The future may bring turbulence, but informed, adaptable investors can navigate structural change and potentially emerge stronger.